Hi, this is Chris from Stockspot, and this video is going to be about investing for charities and not-for-profits. So if you're on an investment committee or a board member of one of these, this video is for you. I'm going to be focusing on some of the mistakes I've seen charities and not-for-profits make when it comes to their investments, and then also how you can solve them. And this is a topic that's very close to my heart because I've sat on the investment committee of a charity, and having that experience and also seeing a lot of our charity and not-for-profit clients at Stockspot, I'd like to share some of the opportunities for improving your investment performance. Now, obviously, as a charity or not-for-profit, your number one goal is to deliver the best possible outcomes and returns for that cause. And so it's very important that any money that you have saved is actually growing and benefiting the charity in the best possible way. And so the first mistake I see a lot of charities make is they're paying way too much in fees to their investment advisors, to their brokers and their asset consultants to provide them with an investment strategy. And fees are just so important when it comes to long-term outcomes because just a small difference in fees, if you're paying 1% versus 0.5% per year, can make an enormous long-term difference on how much money you have left over to support that cause. And the data and evidence shows that higher cost strategies are no better than lower cost strategies. So every dollar you save in investment fees is a dollar that you can use to actually support your cause, whether it's a local community cause, a religious cause, or any other sort of charity. That money is going to be there for you to use instead. When it comes to fees, our approach at Stockspot is to recommend low cost index funds. These are very boring, long-term wealth creation products that I think are brilliant for charities and not-for-profits because they're tax efficient, they're low cost, and they help to build wealth in the most efficient way over the long run. And there isn't leakages of hidden fees and performance fees and brokerage and other unnecessary costs that leak out into the financial industry rather than staying with your cause. And just a small difference over a long period of time can make an enormous difference of hundreds of thousands, if not millions of dollars for larger charities. So this is a really important one. The next mistake I see a lot of charities make is falling for industry jargon. Now, asset consultants and advisors love throwing around complex words like multi-manager approach or alpha or tactical asset allocation. But all of these words are just ways to justify higher costs, and all of the research and evidence out there shows that they do not add value to charities over the long run. There have been a lot of studies that have been done globally that show that a charity that invests in a low-cost diversified index fund portfolio does better almost always compared to charities that invest in more complex strategies, alternative assets, credit funds. These are all fancy products that come with high fees and don't improve your risk-adjusted returns. You know, I've seen this firsthand, having worked with lots of charities and had a look at the investment performance of their portfolios before they came to Stockspot, but there've also been a lot of research to look into this. So don't fall for the jargon, ask what it actually means, and be very skeptical about the jargon terms that asset consultants and advisors are throwing out there, and realize that it's really just to make their jobs seem more important so they can justify higher costs. The next mistake I see a lot of charities make is being misled by performance tricks. Now, asset consultants and advisors are experts at showing that they've outperformed even when they haven't. In fact, I don't think I've ever seen an investment advisor show that they've underperformed, even though we know the evidence shows that about 90% of them do. And there's a couple of ways they do this. The first of all is by not including fees in their performance data. And I can't believe this still goes on today, but a lot of advisors and asset consultants show their pre-fee performance, which is completely irrelevant because you can invest in a low-cost index fund for next to nothing. What's most important is the after-fee performance. So if they're showing you pre-fee performance, tell them to take it back and show them what you've earned after fees. And the other mistake I think on performance I see a lot is benchmarking to the wrong benchmarks. So an asset consultant will show a asset class like infrastructure or unlisted property and benchmark it to something that's too easy a hurdle like inflation and say that they've beaten that benchmark, where actually they haven't beaten other similar funds or other similar asset classes out there. And so make sure that if they are benchmarking their performance, it's to the correct index or to the correct equivalent asset. I like to look at low-cost index funds of a similar asset class, and that's really what you should be benchmarking to, not some sort of self-defined benchmark that's like inflation. The final mistake I see a lot of charities make is really trying to be too short-term and tactical in their investment decision making. Now, I know from firsthand, sitting around as an investment committee, you feel like you need to make decisions all the time. You go to your quarterly meeting, you think that you need to go overweight equities. Should I be selling emerging markets? Should I be buying more bonds? Should I be realizing more cash? Really the only decision you really need to be making is about ensuring that you have enough cash flow to meet your cash flow needs, and that your investment strategy continues to map correctly to your long-term goals, and that you've rebalanced it appropriately to make sure the risk is in line with the risks that you should be taking. Anything else is really just gambling. And I know a lot of brokers and advisors and investment banks have their in-house views about which assets to go overweight or underweight. This is all garbage, and unfortunately it just leads to overtrading, too many transactions, and higher costs, and there's no evidence that it adds any value to your long-term goal of building wealth in that charity. So ignore short-termism, stick to the same low-cost strategy, automate as much as possible through rebalancing, which is what we do at Stockspot, and then ignore the noise. There's very little chance you're going to be able to outperform by trying to pick asset classes, time the market, decide when to be in and out. So don't even try. That's not your responsibility. That's not something you should be doing. Focus on the things that you can control as an investment committee, which is your costs, your risk, which is your asset allocation, and your own behavior. Everything else, forget about, because you can't control it, and focus on the things you can. And I think they're the big mistakes I have seen charities and not-for-profits make. I'd love to hear your views about where charities and not-for-profits go wrong in their investing strategies, or any personal experiences you have, in the comment section. And if you're interested in this video, please subscribe to my YouTube channel, or contact our team to ask about how Stockspot can help charities and not-for-profits invest.